Hi and welcome to Swissquote's Daily Market Talk. It's Monday, September 8th. The weak US jobs data on Friday further fueled the dovish Fed expectations, but investors are cautious still before this week's inflation update from the US. In Japan, the Japanese PM resigned over the weekend. The French PM is about to face a government collapse today and may also be forced to resign. And OPEC decided to bring more barrels to the market from October, but the rise that we saw over the weekend was less than expected and more flexible than thought. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. 22,000. That's the number of jobs that the US economy added last month. 22,000 new non-farm jobs, which is quite weak and well weaker than expected by analysts. And plus the prior month's revisions also show that the US economy actually lost jobs in June. And the unemployment rate in the US climbed to 4.3%. That was expected by analysts, while the participation rate slightly improved, but the latter barely improved the outlook for the US jobs market, which is clearly weakening. And the US jobs market is expected to deteriorate more due to mass deportations, restrained immigration, and tariff uncertainties, of course. And plus 12,000 more manufacturing jobs were lost in the month of August, hinting that the bleeding in the US jobs market may continue before the manufacturing jobs will come back to the US as it is wished by Donald Trump and his administration. But most production line jobs will, however, be waiting to be replaced by robots, in my opinion. So it's not going to be all rosy, it's rather going to be quite bumpy. But anyway, that's not happening tomorrow, happily. And the weakening jobs market data today fuels the expectations that the Federal Reserve will not only cut its interest rates when they meet in September, but the Fed members will have to cut more roughly to prop up the US jobs market and make sure that if it fell behind the curve, which many people think they have, well, they will have to compensate for their late response to the weakening jobs market in the United States. To me and to many others still, the Fed's decision until here to wait and see what happens on the inflation front amid tariffs did make sense, and that the Federal Reserve could hardly paint the US in pink these days despite the major disruptions that we see to trade and many other political policies. But it's sure that if inflation doesn't pick up in the US, which is extremely odd, mind you, but then yes, if it doesn't pick up, well, the Fed will have to lower the interest rates to avoid Donald Trump and public rage. So here we are today. The US 2-year yield shortly dived below the 3.5% mark on Friday after the US jobs data was weaker than expected and is consolidating just above this level this morning in Asia. The probability of a 25 basis point cut in September from the Fed rocketed past the 100% mark, which means that the activity in Fed funds futures now assesses 100% chance for at least a 25 basis point cut and 10% chance for a 50 basis point cut. And many out there now think that the Fed will cut the interest rates in all of the remaining 3 monetary policy meetings before this year ends, and could eventually pose its balance sheet tightening as well to give some more support to the financial markets and to companies, depending on how fast the job market deteriorates, of course, and how much inflation ticks or doesn't take. So this week we'll shed some light on inflation dynamics in the US. Remember, last month, the CPI number actually showed no particular pressure, no particular stress from tariffs on consumer prices, but producer prices jumped significantly. Remember, hinting that the tariff costs were actually mostly absorbed, mostly eaten by companies themselves. So we will now see if a part of that input cost pressure is passed on toward the final consumers and whether that impacts the CPI numbers to the upside. So on Wednesday this week, the PPI data from the US is expected to show that upside pressure in input costs may have ease in the month of August, but on Thursday, the CPI update could eventually warn that the headline CPI in the US starts showing the tariff-led pressures in consumer prices. So the thinking goes, a stronger than expected inflation data this week could help taming some of the Fed dovishness, but interest rate cuts in the United States are welcoming, and they're welcoming from this month, and the risk assets will continue to benefit from the yummy smell of upcoming rate cuts starting from this month. As such, the S&P 500 hit a fresh record high on Friday after the payrolls data showed further weakness in the US jobs market. The index closed the session in the negative, but more stocks in the S&P 500 actually gained on Friday than those who lost. So the limited upside could be somehow blamed on Nvidia on Friday, that saw its market price slide 2.70% on news that OpenAI will start mass production of AI chips with Broadcom. So it's quite needless to say that the capital flew into Broadcom, sending the stock price up by more than 15% at the open before giving some of these gains throughout the session. The stock still closed the session by more than 9% higher. In Asia, the dovish Fed expectations fueled investor appetite at the start of this week as well. The Nikkei jumped in Japan at the open, and the European and US futures are hinting at a bullish start to the new week of trading. Meanwhile, the Chinese investors were a bit worried. They were a bit concerned by the latest data that actually showed weakening exports and smaller than expected trade surplus in China in August due to the trade tensions. But coming back to Japan real quick, the PM Shigeru Ishiba resigned over the weekend to answer the mounting pressure within the LDP to step down. So the news sent the dollar yen a bit higher at the open on expectation that the replacement will actually push for more ample fiscal spending in Japan and less fiscal discipline, and also on the expectation that the political uncertainty and the political instability of Japan could eventually delay a BOJ rate hike. But the dark side of the story is that the Japanese 20 and 30-year yields actually reverse a part of the past two sessions relief and are pushing higher again this morning on budget concerns. So the rising long-term yields in Japan and elsewhere in the Western developed markets is a quietly building risk for the global risk appetite, because in the US, the 30-year yield tanked below the 4.80% level after the weak jobs data on Friday, but risk here prevailed due to the exploding debt levels of the United States and little budget discipline on horizon. And speaking of risks, the French PM François Bayrou will be on the chopping block today, literally, as his government is more likely than not to collapse following a no confidence vote that we expect from the opposition parties today. So the latter could weigh on French stock and bond markets in the very short run and also limit the upside potential of the euro into the 118 resistance against the US dollar. But the US dollar's trajectory will obviously say the last word on whether the euro dollar deserves to reach that 120 psychological mark or not. Now, the net speculative positions in the euro are strongly positive since the start of this year, meaning that most of the positiveness is already baked in the market prices and that any bad news could trigger a downside correction in the short run. In the energy space, US crude actually kicked off the week with a rebound after testing the $62 per barrel support on Friday into the weekend's OPEC meeting that was expected to bring the announcement of more supply from the OPEC countries. And the announcement did come, and OPEC did say that they would indeed increase supply by 137,000 barrels per day starting from October. But that figure was lower than their previous announcements, and it was also lower than expected by analysts, and it is flexible. So OPEC could decide to increase or decrease production in the future. So the letter led some oil bears to take their profit after last week's 3.5% slide, and we could see further correction to the upside into the $65 to $66 per barrel range, including an important Fibonacci level and the 50-day moving average. But a rise above this level, above this range, would actually require a renewed geopolitical turmoil and maybe an OPEC reversal in its supply strategy. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.